Okay, good evening everybody, and my apologies for being 3 minutes late. Just had to clean a couple of documents up that we're going to be referring to tonight so that we can all see them nice and clearly, as I've made a bit of a mess of one of them with some ink. So, all ready to go now. Hi, Filsey. Good name. So, my friends, welcome to class number 3 of our epic journey through the P7 course. Couple of points. Number 1, I've made some adjustments to the study planner that will be updated because, as I think I said before, the timings that were on there weren't right, and I wanted to just take a look at it and have it better reflect the actual speed that the course goes at. So I've made some alterations to that. If you've not seen it yet, you will be seeing it very shortly. And one important thing from that is that when it comes to the progress test questions on P7, I've always had a problem with the first one after week number 2, because we've never really done enough to be able to do that much in the way of a real exam question. So in order to give us a little more scope as to what I can get you to have a go at, the first progress test question on P7 is now after class 3, which is this class. So we've covered a bit more stuff. One more thing to share with you this evening is that I'm struggling a bit with the throat, so I'm keeping the top button undone just to give me muscles a bit of room to move. So apologies for that. I haven't forgotten my tie look. Here is my tie. If it makes anyone feel any better, I can hold it there while teaching, but I'm going to avoid having it actually done up tonight. I hope that that does not upset any of you. I do my best. Anyway, so we need to get going, I guess. So let us get going. I will do my little disappearing act and go wee ah, and now I am tiny, and there is the screen. Must remember, point with the left hand. There it is, you see. Right, let me start, my lovely people, with a reminder. Let's just get a decent pen. We don't want that one, we want that one, of what we covered last time. Let's have a look at the highlights from class 2. Certainly a lot more highlights in this than there were in the England match, weren't there? So, key things that we saw last time. Last time we finished off chapter 1. Nothing too exciting in there once we'd finished it. But our main effort last time was we looked at an ethical and professional issues requirement, which is a very common requirement to come up on the P7 exam. Typically it's question 4. And what did we see from that? I'm not going to remind you what the 4 things are, but the technique was there are 4 ethical dimensions to be looking out for, and it seemed about 4 professional issues dimensions to look out for. And the key to it was reading the stories, but not leaping straight in on one thing that you could see was a clear point. It was reminding yourself that if it's worth 8 points and it's issues, actions, then you're looking for about 4 of each, not 1. It's very easy to get weighed down with the one issue that's jumping out at you, but you need more than one issue, and the best tactic, therefore, is to have a nice couple of checklists and read each story and then compare the story with your checklist of ideas and squeeze as many different points out as you can. You might not necessarily squeeze the same points out that I squeeze out. That's not that big an issue. The point is, if the question needs 4 issues, you've got to find 4 issues from somewhere, and the ideas generator list, as I like to call it, seems to work rather well. So in terms of the content for your answer, coming up with enough ideas, that was the tactic. We then focused on the writing part of the answer. We've got the ideas, now let's get them down. And the key to that part is, of course, 10-pin bowling, golf, whatever you like. It's about thinking the technique as you do it. If you do that, the thoughts will come down your arm, into your pen, onto the page, and into the marker's warm heart, so they can award you with lovely marks. And in terms of the question last time, once we got our ideas, the thinking bit while we were writing, and this will apply to virtually every question we look at, involved thinking. Let's try and get 2 to 3 lines of writing per point we try to earn. Let's try to use the word because as much as we possibly can. Force ourselves to explain it. And the dates are typically very useful on P7 exam stories, so let's try to use them. So for example, in the question we did last time, excuse me, in the question we did last time, one of the scenarios said that the client's year end was the 30th of November. The date in the question was December 4th, so we are just 4 days after the year end. And even if you'd been told nothing else, if that is the dates, or those are the dates that you're being given, that should tell you that the planning stage that happened before the year end will have been done, but the main audit work, the substantive testing, the finalisation and audit report are still to happen. So you're in the middle of the process, if you like. Hello everyone. Hello Ramsha. And then we had this issue with the audit manager having stored her boat for 6 months on the client's premises at a nice cheap price. And what does this tell you? Well, what it tells me is that if it's currently 4 days after the end of the year, if she's being billed for 6 months of boat storage, in all likelihood that boat has been stored for some time and before the audit planning would have begun. Because the audit planning would typically happen about, oh, I don't know, 6 weeks before the year end, possibly a little earlier, a little later. So with the rental of the boat space being 6 months, that tells you that when that audit manager did that audit plan, her boat had been stored or was still being stored and at a nice cheap price, meaning she was thinking happy thoughts about the client. Which means that one of your issues is the audit planning is no longer reliable. It needs to be reviewed and probably redone. If the invoice was for 1 week's boat storage, there is a chance that it was last week and it was after the audit planning, meaning the planning wouldn't have been affected. Of course, if it was only for 1 week, one would be tempted to ask if the value was even worth looking at. So the dates are important. Remind yourself to think that, and you will try to talk about them in the answer. If you don't remind yourself, the chances are you'll never say anything. And there will be marks in the marking key for latching on to those sort of points. Anyway, that was the key to last week. I think just at the end of the class, I suggested that you might want to go take a look. Whoops, we're at the wrong end of a chapter, look. Let's go all the way back there. At the early part of chapter 2, the class notes, and start to remind yourself about the ethical stuff, which is all really a reminder from paper F8. We've already done the exam question. So to a great extent, we can go through the technical knowledge relatively quickly. I mean, if you can already do the question without looking at the class notes, they must just be background knowledge, really, mustn't they? But obviously for some of you, F8 will have been some time ago. And for all of you, there are 1 or 2 issues in the ethics that I do need to expand upon, because they're the sort of things that are a little more advanced at P7 than you would have seen at F8. So, As you will see in Chapter 2 of the class notes, we have got 3 topics to look at. We've got the Code of Ethics, or the Code of Conduct if you prefer, and that is not going to take us too long because most of it you have seen before. But as we saw with the question we practiced, this is very examinable. So it's a good topic not just to know, but to understand. We then get to look at fraud and error. That is another audit standard, number 240. Again, from the F8 course, so you will have seen this before, so we can go through that fairly quickly. And then the final area we look at, professional liability, understanding how auditors become liable to others. Because as an auditor, you need to understand when you've become liable to someone, because if you make a mess of your work, they're likely to sue you, and you are likely to be paying them some money. So, worth knowing about. Right, off we go then. Let's whiz through the intro stuff and get straight into the meat of the chapter. So, a couple of fairly basic reminders from F8. Ethics important because of trust. As accountants, we must be trustable, and therefore our behaviour is very important. ACCA's Code of Ethics is based around 5 fundamental principles. Some of them we need to look at in a little bit of detail within the chapter, but all of them are relatively basic concepts, and as such don't usually come up for many marks, if any marks, on the P7 exam. But make sure you can give a 1-sentence explanation of what each of these 5 things mean. Shouldn't be difficult. Paul, could you please make a list of all examinable standards? Ramsha, I already have a list of all examinable standards. As do you, by the way, because it's called the Study Guide and the Examinable Documents. It's on the ACCA's website. Having said that, it is also in the front of our study manual, and it is quite correct in there. I know I said in class 1, I think, that the front bit hadn't been updated. The examinable documents, as far as you're concerned, they're the same. But at the end of this course, not now, but at the end of this course, all of you will have made available to you a PowerPoint summary of all the audit standards that are on this course. I don't like doing it now for 2 reasons. 1, you'll forget you've got it and won't look at it nearer the exam. And 2, if people know they've got nice summaries of things, they tend to switch off and sleep when they should be awake and listening. But you will be getting that, okay, in the number order of the audit standards. The accounting standards are all in one place in the notes, but the nature of this is the audit standards are dotted around, so I find the useful document helps everybody. Okay, so conceptual framework, just a reminder again from F8 that the problem with rules is that they tend to be very limited, and the problem with behaviour is it's a very broad area, and we could invent all sorts of weird situations, and you can't have a rule for every situation. So the ACCA's approach is to create a sort of set of concepts, and if we follow the concepts, we should be able to apply them to any situation that happens. Yes, Ramsh, I did do it for F8. To be honest, it's the same document as F8, but there are 3 additional standards that come in at P7. So I've added those in, and there are 1 or 2 comments within the document making it clear where things are more useful at P7 and less useful, etc. Anyway, so all of that's fairly boring. The useful stuff really kicks in about here. If I taught you F8, you'll remember my way of doing this, I guess, that with objectivity there are 6 threats. Safim. And the class notes are now going to remind you of those 6 threats with some examples that give rise to each. Just before we do that, A reminder that objectivity, one of the fundamental principles of behaviour, is important. We must be objective, because if we can look at things without outside factors affecting us, we should come to the right audit opinion. And we need to be seen to be objective, because then shareholders will trust our audit report. 6 threats: self-interests, and then on the next page, self-review, intimidation, familiarity, avocados, no advocacy. And then, just to confuse you, the last one, the bullet point system has gone horribly wrong, and it should say management like that, and then there's an example. So sorry about that. There you go. We have all 6. Now, most of the examples in the class notes should not need explaining. For example, auditors owning shares in a client, gifts and hospitality clearly create self-interest threats. But there are 3 in this section that I think need a little more explanation. Obviously, if there's anything else in here you don't understand, ask. That is why I am here. But the 3 I'm going to pick on are contingency fees and lowballing, from that list there. And then, if we go over the page, second opinions. So I'll say a little bit more about those 3. All 3 of those could, in theory, have come up on F8. It's just that on the F8 exam, the F8 examiner tends to focus on easier things. You know, your brother's the finance director, your staff own shares in the client, you've been taken on a luxury hotel weekend, etc. P7, likely to be a little more complicated. So let's take a look at those 3, and we'll do it on a separate page. Starting with contingency or contingent fees. Now, the idea here is that a contingent fee is a fee that depends. You've heard of a contingent liability, a future obligation which depends on the outcome, for example, of a court case. Well, contingent fees are simply where the audit fee, I'll assume this is an audit assignment for the sake of the example, where the audit fee depends on the outcome of the audit. For example, the client might suggest that the audit fee should equal 5% of the profit figure once the audit work has been completed. So in other words, once the finalised accounts are known, client suggests 5% of profit. Okay, now I would imagine that it's pretty obvious to most of you that that is a problem, because if the auditors are getting effectively a share of the profit, then there is a clear self-interest threat to ignore anything that you find on the audit that makes the profit fall. No, 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 you say, I am a professional. If I find something that makes the profit fall, bad luck me, I'll get less of a fee. Unfortunately, congratulations on being so incredibly full of integrity. The outside world, if they saw this was the deal, will assume that you have talked up the profit. Doesn't matter whether you have or haven't. Remember, you must be, and be seen to be, objective. So that is contingent fees. I think you can see why that is a problem, and it is considered such a big problem that contingent fees are banned for audit work. Now, to be honest, they are a major problem whatever the work is that you're doing. Imagine you're doing tax advice for a client and you go to the client and say, do you know what, I'll tell you what I'll do. I will charge you a fee of 10% of any tax I save you. So if I don't save you any tax, you don't pay me anything. Attractive, and I'd imagine clients would like that. I mean, they get to keep 90% of the saving, you get a fee, everyone's a winner. But the danger, of course, is the outside world might assume that since you only get a fee if you reduce their tax bill, maybe you will, how shall we put this kindly, cut a few corners to make absolutely sure you cut their tax bill. In other words, you'll cheat. So even on tax work, where you would imagine it would make a lot of sense, it is still worth putting in the answer that this creates a self-interest threat and therefore it is best not to offer it. So that is contingency or contingent fees. What was the second one? It was lowballing. So what is lowballing? Lowballing is setting an artificially low fee, typically to help win a new client. Now, you often see this in television adverts, magazine adverts, you know, never knowingly beaten on price. If you can find anyone cheaper than us, we will refund you twice the difference, etc. The intention of being the cheapest. Because a lot of people, of course, are price conscious, and so if there are clients out there who will just go with the cheapest option, fine, be the cheapest option. If you're a new player in a market, going and offering your services for free to show off your quality can help to win clients that you can charge more realistic fees to at a later stage. So it makes a lot of sense. However, it does create a problem. Price gives out signals, and if you walk into a shop and there are, I don't know, 3 pairs of headphones for sale and they are $10, $50 and $500, the natural assumption is that $500 is amazing and $10 is probably a bit rubbish. Not necessarily the case, of course, but that is the presumption. So if we start doing our work and charging a very cheap price, there is a danger that it gives the impression that we are low quality. So we've got to be very careful about this. And it's not just the impression, is it? If your staff know that there's not much money being made off this work, maybe they cut a few corners, do it a bit quicker, a bit cheaper. Maybe the quality follows the price. Now, we ought to be a little bit sensible here and just counterbalance that argument. Because if you're doing this to try and win a new client and impress a new client, surely, if anything, the quality of your work will be amazing compared with normal. You're trying harder, you're going the extra mile. But the danger still remains that work done for a cheap price is at risk of being done, or being seen to be done, at a low quality threshold. As a result of that, you are allowed to lowball. I mean, all businesses have the right to charge whatever they wish. You are allowed to lowball, but it is critical that you must tell the client what the usual price is. That way they can see that they are getting a genuine deal and also understand the real value of the work that's being done if you were charging proper commercial rates. And also, you should put safeguards in place to ensure quality of work does not fall. Again, if you're trying to win a new client, it would make sense that when you come to the end of the work, you get one of your colleagues, second independent partner, to come and do a hot review of the work you've done to make absolutely sure that it is decent quality. Partly because you've lowballed, but partly because when you're trying to win a new client, getting a few of your colleagues to check that you've done the best job possible makes commercial sense, doesn't it? So that is contingency fees and lowballing. Probably the hardest of the three I've identified is the third one. Second opinions. Let's imagine you wake up one morning and you really want the day off work. You're feeling a little bit ill, so you go to your doctor hoping the doctor will give you a sick note, a prescription, and you can photocopy it and send it to work. But your doctor spends 5 minutes with you and says, "No, you're fine, go away." So you go to another doctor who says exactly the same thing to you. So you go to a third doctor, except now it's different, because now you start inventing extra pains and you make yourself look even worse. In other words, you cheat. Eventually you find a doctor who takes one look at you and says, "You look awful." You're not ill, of course, you've just made yourself look and sound awful to try to get the day off work. So, here's a potential risk. What if a company that is not your client asks your firm for an opinion on something? Now, there are two big potential problems here. Problem one is that because they're not your client, you only know a limited amount about them. Basically, you will know what they will tell you. And if they are shopping around for an opinion that they want, the danger is they'll only tell you what they want you to know, and they'll hide other facts from you. Now, they might do that on purpose because they are shopping around for an opinion. They might do that accidentally because they don't realise the information is relevant. Of course, if they were your client, you'd know a lot more about them, and the risk of information not passing to you is greatly reduced. If you barely know these people, you'll only know what they tell you. And that creates the risk that you give the wrong opinion. But there is a second risk, and that is that the company uses the opinion you give them to intimidate their own auditor to change their minds. And that's why it creates an intimidation threat. So I suppose, turning that around, one of your clients might go to some other accounting firm and then come back to you and say, "Well, I know you say debit that, credit that, but we've been to KPMG and KPMG say debit that and credit that." And that is going to be very difficult to argue against. So those are the two problems: lack of information leading to wrong opinion risk being high, and secondly, the risk of opinion shopping, and then intimidation. Now, we cannot stop companies making phone calls and sending emails. What we can do is control the reaction of us auditors when we receive such a request. So how should we respond to a second opinion request? Well, what I would suggest is this: only give a second opinion if, number one, you issue a disclaimer with it stating it is a preliminary conclusion based only on the information that was provided to you. And if they want something more reliable, then they need to spend a bit of time with you so you can get all the appropriate information together. And secondly, if you do go to a brand new doctor and say, hello, I want an appointment, that doctor is going to contact your existing doctor and get your medical notes. It's common sense. They want all the right information because the risk is they prescribe you drugs you could be allergic to. They could kill you. Well, you are going to do exactly the same thing. You are going to contact their existing auditors and see if there's any other information you're not being told. That will help you provide a better opinion. It will also help you understand if these guys are opinion shopping, because if they are, they'll probably refuse to let you talk to their existing auditors. And thirdly, it removes the chance of the intimidation threat, a bit at least, because now their existing auditors will know that they are seeking opinions from elsewhere, which gives the existing auditor the opportunity to explain what conclusion they came to based on this information and why. So that is how audit firms should deal with requests for second opinions. Apart from that, there's really nothing more to say about the threats to objectivity. It is a reminder from the F8 paper. The job is not to learn all the threats. You need to be able to explain why advocacy, familiarity, self-review, etc. are a problem. And we did some of that in the question last time. And then you just need to be prepared for whatever scenario your examiner might come up with, which might be something you have never ever seen before, even if you've practiced every past exam question. Just apply the theories with those checklists I gave you and question the story one at a time, going, self-interest? No. Advocacy? No. And just go down the list. Right, so those are the various types of threat, and then further down page 21 we have a reminder about some of the typical safeguards that firms of accountants use. So for example, typically rotation of audit staff is aimed at the familiarity threat. Let's pick out another one. Using separate teams is usually done to stop members of the audit team reviewing work they've done while supplying another service to that client. And if you come down here to the big client issue, don't have one big client who is too big a percentage of your overall firm's fees, and that should help to deal both with a self-interest threat, being nice to a very big client, and the flip side of that, the intimidation threat of big clients pushing you around. Down at the bottom of the list, our old friend hot reviews. If you're ever worried about ethical threats on an audit, get a second partner to check the audit files before they are signed off, so before the audit report is signed. And notice this point down at the bottom. Where you've got a high-risk client, listed on a stock exchange or in some other way public interest, maybe a charity, a very high profile client, client in a highly regulated industry, if you see there are ethical threats as you analyse your client at the beginning, go and get a second partner to review the ethical threats analysis before you even say yes to this client. So in a more general sense, if anything is ever happening on a high-profile audit, which is very important, don't be afraid of going to get a second partner in the office and say, before I continue with this, can you take a look and tell me we're doing this right? It's common sense, really, isn't it? Don't have to wait till the end. You can do it at any point you like. There are some accounting firms I know, smaller ones in particular, who every Monday morning will have a partners meeting, and where there are potential new clients, the partner who has been approached by this client will share the story around the table and say, guys and girls, what do you think? So they can openly discuss potential ethical issues and whether the firm should take that client on. Okay. There we go, that's threats to objectivity. The next two areas, again, very much F8 revision. Confidentiality, fairly basic at the P7 level in terms of knowledge. But remember from last week, have it on your little checklist when it says ethical and professional issues. And just ask yourself, is there anything happening in that story that either requires disclosure by law or disclosure by choice. Now, law's the easy one because you've got no decision to make, have you? If you think something is happening at a client that is in the public interest, well, that's a bit harder to deal with. And with that one, absolutely get some legal advice and see what they suggest. So that's confidentiality, pure case of revision from F8. And then similarly, conflicts of interest is also revision from F8. And this one doesn't come up much because whilst the situations can be very complex, the solution is always the same thing, and is this thing down here. So if, let's take two big competing companies, if Samsung and Apple both came to me and said, Paul, we want you to be our auditor, I'd be a very happy man because I'm about to make a lot of money. But of course my problem is, if Apple know I'm the auditor of Samsung, they won't be happy. And likewise, if Samsung know I'm the auditor of Apple, they won't be happy, because they'll be worried that confidential information might pass from one through me and accidentally or not end up at the other. Also, they won't be happy because Apple will want me to focus on their best interests, and of course anything that's good for Apple is necessarily bad for Samsung because they are competitors. So realistically, even if I go down the line of that good old-fashioned solution of two separate teams, from two separate offices, led by two separate partners, and keep all the information stored on two separate servers, when I go to the two companies and say, are you okay with this, the chances are they'll say no. So I am willing to bet that if you go and look at the annual report of Samsung and the annual report of Apple, you will find that both have very big firms of auditors, firms you will have heard of, but they're very unlikely to be the same firm. So there we have it. That is ethics dealt with. Seen it all before, haven't you? But as you saw in the question last week, it's not really the knowledge. It's, can you take stories and analyse them and apply this stuff and then explain yourself in decent words? Knowing it is not the battle. The battle is understanding it, applying it, and being able to explain it, and that takes practice. Let's move on. The next section of the notes, another audit standard, but again an audit standard from the F8 paper. Doesn't come up much on P7. Fraud can come up on P7, but not the audit standard. The audit standard focuses purely on the auditor's responsibility. Nice and simple, this one. Auditors have a responsibility to search the financial statements for, here we go, down the bottom here, material misstatements. Misstatements come in two types, the accidental one, called an error, and the deliberate one, which is called fraud. So the reason we care about fraud as auditors is that fraud is likely to mean the accounts are wrong, and our job is to check if the accounts are wrong. As a result of that, our job is simply to identify the risk of material misstatements. In terms of fraud, that means having a deep understanding of the client to understand why members of staff might want to commit fraud and how they might be able to go about it. So, as I said, what you're doing is identifying the risk that fraud could take place. Once you've done that, it's the same as any other risk on an audit. You design audit work to test if the risks you've identified are taking place. Your big problem with fraud, of course, being that most fraud is carried out by directors, and directors are very good at covering things up because they control everything. Now, there is a chance in the future that our role regarding fraud might expand. At the moment, the auditor's responsibilities are relatively limited. It is not our job to stop fraud, and we have no legal duty to find it. We just have a professional duty to try to find it. As long as we try, we don't actually have to find it. However, we have a little problem in our industry called the expectation gap. This is the gap between what auditors do and what the public thinks we do, or you could argue, wants us to do. And this gap is caused, it is felt, by the fact that the public don't understand what auditors do. So in recent years, the audit profession has tried to educate the public, largely with a longer audit report, better explaining what auditors do, to try to close the gap by saying, this is what we do, let's tell you about it so that you understand it better. There is an argument, as you'll find out shortly, that says maybe, if that's what the public wants and that's what the auditors are doing, the right solution to closing the gap is to get the auditors to change what we do to match what the public demands. More on that in a minute. Let's now move on to the last section of this chapter, auditor liability. It's very important as a professional that you understand to whom you are becoming liable. Of course, if someone pays you for something, you're liable to them. That's called a contract in contract law. But as you're about to see, auditors can become liable to a lot more people than the people who are paying the bill. And it's important that we understand that we're liable to someone because that will affect how we behave. So let's take a little example. You have paid, I hope, for this course. And that means you should have the right to expect a level of quality and professionalism from LSBF and from me, your tutor. If you turn up on exam day for P7 and you read the exam paper and think, Paul didn't cover any of this, we never practiced any questions at all like this, I'll sue, I agree with you, you should. It won't happen. But if it did, quite right you should sue, because clearly you've not been properly prepared for the exam and you've paid for this course. Now that bit's the easy bit. Let me now give you a different scenario. Let's imagine that a student is sitting outside this studio door right now, listening very carefully to how I'm teaching this course. They're not booked on the course, otherwise they'd be watching it just like you guys, but they wandered down the corridor earlier, heard my voice and thought, ooh, if I sit here quietly, I get a free P7 course. So let's imagine there is a student out there right at the moment. Let's imagine that student enters the P7 exam. And don't forget guys, 8th of September. If you want the cheaper price, today is the day to fill in your exam entry. So the student signs up for the exam, the student sits the exam, the student fails the exam, and the student says, hang on, nothing that came up was anything like what Paul did in class. And now they sue LSBF. It's our fault they failed. Does that sound reasonable? Well, I'm guessing that you're probably thinking that's totally unreasonable, because that student who sat out there is a freeloader getting a free course without paying for it, and it's a bloomin' cheek to then blame the college if they don't pass the exam. And you're right, except your logic isn't. The fact that they've not paid is totally irrelevant. The reason we are not liable if there is a student outside that door listening is that I don't know they're there. You see, if I did know there was someone outside doing this, I have a professional duty to inform them that because of the way they are listening, they won't get to see my hand movements, they won't get to see my facial expressions, they won't see what I've written, and because they won't hear it very loud, there's a danger they mishear what I say. As a result, they are not getting a decent service, and I hereby disclaim all responsibility if they fail the exam. Of course, if I don't know there's someone out there, I can't tell them that, and I can't issue them a disclaimer. The key point here is that if a professional knows that someone plans to rely on their work, if you know that at the time that you're doing the work and giving your opinions, you have a professional duty to look after that person. Which means either you make sure they get a decent service, or if you know they can't get a decent service, like the student who might be sitting outside the classroom, let's hope there isn't, then you'd better make sure they understand that and issue a disclaimer. So, how do the rules work for auditors then? Auditors are liable to the shareholders of the company they're auditing. Now this means the shareholders who exist on the date that the audit report is signed. Because that's who my report is to, the shareholders. So I'm liable to them, which means if I do a bad quality audit and the shareholders lose money as a result, I am going to be culpable, and if they sue me, I'm likely to lose and I'll have to pay them some money. We'll come back to that point shortly. But the really interesting question is this, because company accounts and the audit reports attached to them are usually a publicly available document. Anybody on the planet can read it. So if I audit a company, if I've done a bad quality audit, am I liable to other people who weren't paying me for my audit work, but who read the audit report, decided this company was maybe worth investing in, invested and lost? If they can prove that my audit work was rubbish, the accounts were not correct, and it's my fault that they've lost money, can they sue me? Well, the answer is a bit like the student outside the classroom. They can sue if the auditor knew at the time of signing the audit report that that person or group of people was relying. if the auditor knows that that person is placing reliance, a professional duty is owed. Now the judge, if this goes to court, would need to decide if there was a reasonable case here, and it may well be that if a student did sit outside the classroom, the judge would decide that someone sitting outside a classroom has no right to expect to rely on what's going on inside. But if an auditor knows that someone else is relying, not just the shareholders, but someone else, and the audit work is proved to be bad quality, i.e. negligent, and it can be proved that the losses were suffered as a result of the bad quality audit work, then the auditors will be found guilty and will have to compensate whoever has lost out. So, in summary, to whom are auditors liable? The shareholders, plus anybody else if the auditors knew these anybody else were relying, and the auditor did a bad quality audit, and this anybody else lost money as a result of the bad quality audit work. And that is how auditor liability works. But very importantly, just as I could walk outside and say to the person who might be sitting out there, I hereby disclaim responsibility, likewise, the auditor can cancel a duty of care to third parties. So there seems to be a simple secret here. Make sure you're aware of who's relying on your audit report and then send them a disclaimer. But that does create a potential risk that you should have realised someone was relying, or you forget that someone's relying and then you don't send the disclaimer. So how do you issue a disclaimer to all potential third parties? Anyone who might say, oh yeah, we relied on the audit report and we've lost money, so we're suing. How do you make sure you're covered? The answer, of course, is to put the disclaimer in the audit report. Because that way, anyone who says they've relied on the audit report must have read the disclaimer. Perfect. And that is the solution in many countries. But I need to take this one little stage further. I drive a car. I'm sure some of you drive a car. And every so often I drive into a car park, and as I'm driving around trying to find a space, I may well see a sign on the wall that says something like, the management of this car park accept no legal responsibility for any damage to your car while it's parked here or theft of your possessions from within your vehicle. And you know what? The first thing I think when I see that sign is I reckon there have been thefts in this car park and damage to cars, and that's why management have put it up there to try and evade any responsibility. It's telling me there's been a problem. Management are not confident that this car park is a safe place to park. Of course, if they'd spent the money they spent on the signs on some CCTV cameras or a couple of security guards wandering around, maybe that would solve the problem. But no. They just put a sign up and say, your car gets damaged, your bags get stolen, tough, your problem. They've issued a disclaimer. And that raises an interesting question. Does the disclaimer in the audit report reduce confidence in the audit opinion. Does it act like the sign in the car park, suggesting to shareholders that the auditors are not quite as confident that they've got this audit right as maybe you thought they did? I mean, if they were confident, they wouldn't put a disclaimer in, would they? Because they wouldn't get it wrong. And because of that, there are some countries that refuse to allow such a disclaimer to go in. For example, the USA. You can't do this. In the UK, every audit firm does it. It's a standard paragraph in the audit report of every audit firm. But in some countries, the government says, if you're worried about getting the audit wrong, make the audit better quality and don't get it wrong. That's their solution. So there we go. You now know to whom auditors are liable, who they can also become liable to, but a disclaimer can get rid of that liability. And that's why knowing who you're liable to is such an important professional issue, so you can do something about it. If we now go back to the class notes, the second question we need to look at is just how liable might you be? And if the answer to that is a lot, is there anything you can do about it to try to reduce the cost? Now, of course, the ultimate solution here is better quality audit work means you're less likely to lose legal cases. But realistically, the world's not a perfect place, and from time to time, audits will go wrong, just like everything else goes wrong. Over the years, audit firms have not been happy about this situation. You see, let's imagine a company goes bust. 5 billion company is now worth nothing. The shareholders have lost everything. So they're angry, understandably, and they want to sue somebody, because someone must have screwed this up. Now the audit firms say, look, if we did a bad quality audit and the accounts weren't accurate after all, fair enough, sue us. But when companies collapse, it's not the auditor's fault, it's the director's fault, because they're the ones running it. So why don't you sue the directors? And there are multiple reasons why shareholders don't tend to sue the directors. Number one, there's probably only about 10 directors. Number two, if the directors own shares in the company, the directors might be pretty penniless now as well, so sue them if you like, but they can't pay you any money. Number three, audit firms have big shiny offices, which means they're loaded. Directors are just human beings. They've got limited amounts of money. The audit firm's got more. Go for them. Number four, audit firms are required to have professional insurance, which means if they're worried about losing the case, the insurers might just pay out and even avoid the legal battle. And number five, traditionally, audit firms were partnerships. And as you might remember from your previous studies, typically, partnerships have no separate legal identity. So the partnership and the partners are the same people, which means if you sue PwC, first thing they have to do is sell the PwC assets to pay you, and if that's not enough and the insurance doesn't cover it, you can go and take the house keys of every partner in PwC. You can take their personal belongings. So you can sort of understand why angry shareholders go after the audit firm first, because they're more likely to get stacks of compensation. Audit firms have, as a result, been rather upset about this and have pushed successive governments to try to level the playing field a bit. As I said before, if the auditors did bad quality work, they're quite happy to put their hands up and say, fair enough, we'll pay something. What they don't want to do is pay everything. So what are the possible solutions here? Well, we've already dealt with the first one and the disclaimer. That's for third parties. What about reducing your liability to the shareholders? Remember, you can't get rid of that liability. If you've screwed up, the shareholders can sue and you will have to pay them. Can you limit your exposure a bit here? Well, one way is to become limited liability. For example, a limited liability partnership. Similar in many ways to how a traditional partnership works, but now with limited liability, just like a company. Most of the big audit firms are LLPs. That is their preferred solution. Some of them did try becoming limited companies. But the problem with being a limited company is, yeah, you get limited liability, fabulous, but the bad news is the tax tends to be worse. And very importantly, you have to follow all the accounting standards, produce very detailed financial statements, which everybody can read, and that you have to have fully audited by one of your competitors. LLP status tends to have less accounting reporting requirements, and whilst you do have to be audited, therefore the auditors won't get to see quite as much of the secrets inside your firm as if you were a company. Another potential solution which audit firms have pushed for is for the government to set a limit on how much an audit firm can be sued for. Nice solution. The biggest problem with it, though, is deciding what the cap should be. Realistically, the cap for suing PwC, the world's biggest audit firm, would have to be rather higher than the cap for Merrison & Co., a sole practitioner with one partner. In the UK, the government has taken an alternative approach, and in the UK, firms of auditors are allowed to have their own liability caps agreed with individual clients on a one-by-one basis. Nice solution. Let the market work it out. If the shareholders don't want a cap, the audit firm will say, fine, you'll have to find a different firm then, because we're not doing it. So you can see there are multiple solutions here. I've not even mentioned proportionate liability. The logic there is judges, when awarding compensation against audit firms, would have to decide what percentage of the shareholders' losses were caused directly by the auditor's negligence, which could get very complicated. There are some countries that follow that approach, and you'd hope that a judge would be sensible and do that anyway, but there's no formal system for that in the UK. So, at the moment, the two most popular methods are to go for LLP status and then, to get a bit more certainty, try to go for the cap approach. And if the government won't put one in place in your country, see if you can negotiate one, if the government allows it, with clients individually. Now, we mentioned the expectation gap on the previous page, and now we get to mention it briefly again. As I said, there is a push for auditors to maybe do more of what the public wants or thinks we do. Part of this has been caused by the recent banking crisis. You know, Lehman Brothers, Merrill Lynch, etc. All the lovely banks who looked incredibly healthy and then suddenly, almost overnight, looked like they were going out of business. Naturally, the public has said, hang on a minute. Those banks looked healthy and the auditors said their accounts were true and fair. This doesn't just happen overnight, does it? Clearly their accounts were not right, and clearly the auditors should be telling us more. The result of this is there is a lot of pressure to expand audit duties to report on more things, not just the truth and fairness of the accounts, but maybe report on other matters. For example, giving a report as to whether the auditors believe a company is a going concern or not would be a useful addition. As we will see in Chapter 8, there is a new format of audit report currently under proposal. And since everyone agrees it's a good idea, it will be adopted soon. And at this point, all I'll tell you is there are more opinions in it. It is a much longer audit report than the audit report's structure that you are used to. And the reason I mention this in this chapter of the notes is that audit firms believe, probably accurately, that more opinions will lead to an increased chance of being sued. Let's face it, the more things you say, the greater the risk that one of them is wrong. So audit firms want more protection from legal cases. So as the role of auditors goes up, expect the auditor liability debate to continue into the future. That is the point I am getting at. Wow. We've got to the end of Chapter 2. Woohoo! But unfortunately, all that means is we now get to look at yet another chapter, Chapter 3. Oh. So let's do just that. Practice management. Again, I'm all the way at the end. What's going on? Whee. What is practice management? Practice management looks at the issues involved in running an accountancy firm. For example, we will take a look at how audit firms try to ensure quality in everything they do. And this is rather examinable. We need to look at how audit firms advertise, their marketing campaigns, obtaining professional work, which is typically going to involve a tendering process, and how audit firms set their fees. And then we're also going to look at the end of the chapter at the issues that auditors need to consider and the things auditors need to do before accepting new clients. The last bit of this is very much F8 revision, but it's actually quite important on P7, although it's very easy, meaning we'll look at it very briefly today, but we will meet it again when we get to the latter stages of the course, where you'll understand why it becomes so important. Now, I'm not going to do this chapter in the order in which it's in the notes. I'm going to play around with the order a little bit. And we're going to start off with fees. So moving on past page 30 and on to page 31. And down at the bottom of page 31, we have fees. And I have some exceptionally good news for you. There are two things you need to know about fees. Those two things are contingency fees and lowballing, and we've already done it, because we covered it during the ethics chapter. You might have wondered why I was writing quite a lot of extra stuff on the screen. I mean, if it's useful, why is it not in the notes? It is in the notes, right here. But it seemed more sensible to give you the extra as we were looking at the ethics chapter. So there you can see contingency fees, and on page 32 there is the lowballing. No problem there. Remember, lowballing allowed, subject to certain conditions. Contingency fees are banned. Good. Now, right underneath the fee stuff, it says tendering. The logic goes something like this. It's very unlikely that a company will ring me up and say, Paul, I want you to be my auditor. More realistic is a company rings me up and says, Paul, I'm shortlisting you to be my auditor. And then they'll ask me to come in and do a presentation to the directors to try and sell my firm, and they'll also be asking 2 or 3 other firms to go in, and whoever does the most compelling presentation wins the client. So, what is the potential exam question here? The potential exam question is, if you've been asked to tender for a client, go up against other audit firms, how do you win that tender? What goes into the presentation? What does the company want to know about us? What do we want them to know about us? Now, realistically, those of you watching this probably have not done this for real. On either side. You've not been an audit firm trying to win a client. You've not been a client trying to choose between audit firms. There's every chance you can think up 3 or 4 sensible ideas maybe. But let's take a different look at this. Because I reckon that a company choosing its audit firm is like a company choosing a new member of staff. Who gets the job? Which means an audit firm selling itself to a client is like you trying to get a job offer. So my question to you is this. If you're trying to get a job offer, what do you put in your CV or your resume, and what do you want to get over to the client, sorry, not the client, the potential employer at your interview? In fact, what is the employer likely to ask? Because if we understand the answer to those questions, we've got the answer to this, I reckon. So, what goes into your CV? Well, naturally, your work experience, especially in related companies. There'll be an element of your history, how long you've been working in this field, what you did beforehand, a bit of a life story if you like, so they understand where you come from. Naturally, your qualifications. And if you've won prizes, any awards you've won will help to differentiate you from other potential recruits. If you've got any specialist skills relevant to the work, languages for example, computer skills, no doubt you'll put those in. At some point, whether it's in your CV or in the interview, you'd like to know how much money is available and make sure they understand how much you believe that you are worth. And I doubt this would be in your CV, but at the interview they're likely to ask you, if we offered you this job, what would you bring to the company? How would you go about this role within our organisation? And let's face it, if an audit firm is trying to win a client, that's pretty much what the audit firm needs to tell the company. It's the same thing. I mean, we might add on something like locations where you've got offices, because for a big international client. They'd want to know where in the world you are so that you could service them. But basically, it's the same stuff you would put in your own CV and discuss in a job interview, because it's the same process. So if tendering comes up, there's only two questions they can ask. What would you put in your presentation? Or from the other angle, how would a company choose its audit firm? And it's the same answer to both. If you can't remember or your mind's gone blank, ask yourself what's in your CV, and last time you had a job interview, what sort of things got asked? And don't forget, of course, that if they do decide you're a possible recruit, they'll want to take references. And there is nothing to stop an audit firm going to some existing clients and asking for permission to give their contact details to a new potential client, so a potential new client can ask existing audit clients what sort of service level you provide. Rather like job references, of course, it's totally pointless, isn't it? Because which of your clients will you choose? The clients who absolutely love you. It's like when you give a job reference, you don't go and ask your enemy for a reference, do you? You go to people you know will say good things. Never understand the point of references, to be honest. Okay, so we have done fees and we have done tendering. I know we've missed stuff out. We'll go back to that shortly. Just before we go back, though, let's get to the end of the chapter and finish this bit off, and then we can just go and fill the gap. The chapter finishes by looking at professional appointments, and much of that is covered by Audit Standard 210. That's the standard that covers engagement, so engagement letter and things like that. There's a nice simple section at the top of the page. You could be asked why companies change auditors. Why do you change hairdressers? You don't like the people, there's been an argument, you fancy a change. The prices have gone up, all sorts of reasons. This is the bit I was referring to earlier, nice and simple. And as you'll see later in the course, rather surprisingly, this does come up, even though it's pretty basic. You know, what to consider before saying yes to a client. Have we got the staff, the time, the resources? Will the client pay the fee? Threats to objectivity, conflicts of interest? Are we concerned about the integrity of the client? But all of that's pretty basic. There is one thing I just want to remind you of from F8, and that is this bit here. Preconditions for an audit. It's F8 knowledge, but it is a little bit higher level than a lot of the stuff on F8, so it could come up on P7. Basically, before you can say yes to doing an audit, you need your client to reassure you on three things. And those three things are, number one, the client has prepared their accounts using an appropriate and accepted form of financial reporting, typically, of course, international financial reporting standards. So they're following the right set of rules. But they must also guarantee two things that the auditor needs to be able to do an audit. Do you have to publish a reason for changing auditors? You don't have to, but because the new auditors will have to be put to the shareholder vote, I would expect at your AGM to explain to the shareholders why you think it's needed or time for a change. So you don't have to, but you will do. So auditors need to get evidence, and we get our evidence from two main sources: testing controls, substantive testing. So because of that, before we agree to do an audit, we need to get the directors to confirm to us that there is an internal control system in the company, and secondly, they promise they will provide all the evidence that is available. So before you do an audit, check they're using the right accounting standards relevant to their company. They promise they have an internal control system. They guarantee they'll supply all the evidence. Bingo, and you can go and do it. Sign your engagement letter, terms and conditions of the audit, job done. Engagement letters are very minor on P7. To be honest, they're too easy on the F8 paper, let alone at this high level. So there we go. We've reached the end of the chapter, but we have done that by cheating a little bit. Because there's a couple of things we've missed out. And the first of those, whizzing back up to page 31, is advertising and publicity. There's two main angles, I guess, on this. Number one is to think how accountancy firms advertise, and secondly, the actual content of the advert. The notes focus heavily on the content because there are rules. Before we look at those rules, though, let's instead look at how accountancy firms advertise. When we all go home tonight, maybe we'll switch on the television, watch a little bit before we go to bed. Realistically, you are probably not going to see adverts by Deloitte, KPMG, PwC, Ernst & Young, Grant Thornton, etc. They don't advertise on TV. Why not? Well, the reason, of course, is accountancy firms need to target their adverts at the market who are making decisions, and the market they need are company directors, because directors are recommending firms to shareholders. So you need to target directors. Now, don't get me wrong, directors do watch some television. It's just that compared with other people on this planet, they probably watch a fair bit less. So if they're not watching TV, where are their eyes looking? Well, they are far more likely to have the money to be able to attend music, opera, art exhibitions, the luxuries of life. They're more likely to attend sporting events. But I don't mean the relatively cheap sporting events or the events that are more the area of the common man, if you like. So I'm not going to say the boxing and the football and the stuff like that. They're more likely to sponsor the type of sports that appeal to higher brow individuals, if you see what I mean. So things like yachting, sailing in other words, rugby, golf, always a popular one, polo, rowing. So the sort of events where corporate sponsorship and corporate hospitality, people being wined and dined, is more likely to happen. Next time you see a golfer being interviewed on television, take a look at the names, the patches on his hat and on the clothes. Often you'll find a firm of accountants on there. And of course, business magazines and the business sections of newspapers would make a lot of sense. Company directors will be reading things like The Economist, The Financial Times. There's a magazine called Company Director, pretty obvious place to advertise. Accountancy magazines will also be likely to target the right sort of people. Now, don't get me wrong, there is some mass advertising as well. Depends what it's like in your country, I guess, but in the UK, most of us come to work by train. So advertising on big billboards next to train stations makes a lot of sense. Yeah, the company directors have got to get into London as well. In some cities, company directors don't use public transport because the road system is good enough that they'll come in by car, so there's less need to advertise. But in the UK, pretty much everyone gets into London by train. Airports, of course, are a great place to advertise, especially business class lounges and in the magazines inside the actual aeroplane itself. A lot of people travel on business, of course. They want to read something while they're on there. So you might get a question which says, here are some suggestions for new advertising campaigns at your firm. What do you think? And one of the things it will suggest is a location for the advert. So use a bit of common sense. Does it look like a sensible location where directors will be hanging out? But now we've looked at the location, the next thing I want to do is to focus on the content of the advertisement. Now the rules are all in the notes and they're all pretty easy. But what I'm going to do is give you an example of a potential advert for LSBF. See what you think. In fact, let's just move it over a bit so we can put comments next to it. LSBF is much better quality than BPP and Kaplan. Paul Merrison is the best tutor in accountancy. Why not? LSBF tutors will do anything and I mean anything to ensure you pass. Let's just start with that little gem of an advert. Now, I'm an accountant. We are teaching ACCA papers. The ACCA monitors us as well, therefore, just like it monitors its own members who are practicing accountants. So pretty much the same rules apply to us as they do in accountancy. Now, you're probably looking at that advert and thinking, that doesn't look good. And I understand that. My point here is that by using the rules in the notes, we can actually explain a lot more easily why we don't like this. Because I know that you're probably looking at this and this, and maybe you're also a bit worried about that. The question is, can you put it into words? Now, maybe the easiest thing for us to do is go back to the class notes, go through the rules, and then we can apply the rules to the advert I've just put there. That would seem to make sense, wouldn't it? Right, here we go then. The rules of advertising are you must be clear and you must be accurate. So obviously no lies, but also you must say things in a way that is clear and would not mislead people into believing the wrong thing. Number 2, no unsubstantiated claims. You cannot say that you are the best at something or better than someone else unless you have clear evidence to back it up. Thirdly, no saying nasty things about your competitors. It's unprofessional. No. I know in some industries the adverts will have one company pointing out that they are better than another company. You know, airlines saying, here's the legroom on our airplane and here's the legroom on all our competitors. We're not going to be doing that. No. You will not see an advert where a PwC partner stands up and says, come to PwC because KPMG are rubbish. Not going to happen. Professionalism in general. You have to remember that as accountants, people want someone who is boring and reliable. We can do adverts and try to be a little bit clever and intelligent. If we end up doing adverts that are seen as too funny or too silly, they're going to drag down the view of the profession. This is one of those areas where I hate to say it, but being boring is actually the best solution. And finally, the ACCA name and logo. Now, you've got to be careful with this. If you are a qualified accountant, a member of ACCA, you get to put the letters after your name. Well done. But there is a danger that if advertising uses the word ACCA or the letters ACCA, that some people might be misled into thinking that you are somehow the preferred accountancy firm of the ACCA, or that ACCA endorse you or authorise you as being better than everybody else. So you can refer to being registered with the ACCA, you can say you are a member of the ACCA, but you're not allowed to use the logo at all. Because if you did, it might make people think you are the ACCA. So those are the rules. Let's now go back to my little example and tie it to the rules. So LSBF is much better quality than BPP and Kaplan. What's wrong with that? Well, two things really. It's an unsubstantiated claim. There's no proof that we're better than BPP and Kaplan. And secondly, it is also criticism of other accountants, which we are not allowed to do. Paul Merrison is the best tutor in accountancy is of course another excuse me, unsubstantiated claim. Now, the problem is not the claim, the problem is you're not backing it up, substantiating it. It would be very difficult, I suspect, to get any proof that you are better than someone else. That is surely a pure matter of opinion. However, if you're able to say something like this, and put a little asterisk there, and then at the bottom of your advert it says, as voted for by PQ Magazine 2013 Accountancy Awards, then that's fine, because now you are substantiating with an independent source that what you are saying is actually what someone else has said. And notice notice how I've managed to get my little prize into class. Aren't I clever? Thank you. The PQ magazine is the PQ magazine is every month. The awards are in the end of January, beginning of February each year, but they start opening up for nominations around about now. So if you want to vote, go to the PQ website. There's an application form you can download. Please feel free to vote for your favourite college, your favourite tutor, because I'd love to win it again. And if you work very hard, I'll nominate you as Student of the Year. On that subject, I might have mentioned this before, one of my F8 students last term was fantastic, worked incredibly hard, brilliant attitude, and ended up getting an amazing mark. I am nominating him for Student of the Year. So I'm good for my word. You put in the effort and go the extra mile, I will nominate you. Promise. Plenty of time this term to show me what you've got. Don't have to wait for results. Just work very hard, show a great attitude, and maybe you get to win a trophy. And in terms of the final point down here, what concerns us down here is the lack of clarity and a potential suggestion of unethical or maybe illegal behaviour. You see, some people might read the fact that it says anything, and I mean anything, and start thinking, hang on a minute, what exactly are you saying, Paul? Are you saying that you'd actually go round to the examiner's house, break in, go and find the laptop, hack into it, find the exam paper before exam day and tell us what the questions are? The answer, of course, is no. But if you start saying, I'll do anything, and I mean anything, some people will read the wrong things into that. So, the message on advertising is very, very simple. There are some rules, and the standard exam question, when this comes up, and it comes up every few sittings or so, is she'll give you an actual advert and say, well, what do you think about that? Just like I've done up on the screen. So the message is simple, isn't it? Learn these headings. Because if you know the headings and it comes up, you have a simple plan of attack for the question. And trust me, if it does come up, all she'll do is have that list in front of her and design an advert that breaks every one of the rules. So if you know the rules, it'll be an easy question. All right, isn't this going well? Well, we've got one bit left to look at in the chapter, and it's actually the first bit, but I'm doing it last. Page 30, quality control. It is absolutely critical that firms of accountants do good quality work. If the quality goes, your reputation goes, and once you've lost your reputation, getting it back, virtually impossible. So accountants are very, very keen to have mechanisms in place to try to make the quality as good as they possibly can. There are two angles to this. Naturally, we want quality on every audit job we do for a client, but before we get to that level of detail, there are some things we can do in our firm as a whole. Now, please be aware that if you do these things in your firm as a whole, it won't just affect the audit work, it will affect all the work you do. The tax work, the consultancy, the mergers and acquisitions stuff, everything. But the quality issues are pretty much the same, whether it's auditing or other work. Of course, it's not just firms of accountants who care about quality. LSBF cares about quality. Your company cares about quality. So most of the things on this quality control within the firm list are going to apply to where you work, to where I work, and to where most people work. Yep, it's good old common sense again. So, what sort of things are we going to do? Well, if we want quality, we design good quality processes, document them, train the staff to make sure they know what they're meant to do, and then have a cold review process where every so often we check the finished work we've done and make sure that our staff are following the processes. But equally get feedback from our staff as to maybe how our processes could be improved, and we put a quality control partner in charge of all of this to make sure we have continual improvement and the processes are being adhered to. If you want good quality staff, training them helps. Of course, recruiting good quality people in the first place helps even more. There should be appraisal. If people do well, pat them on the back. If they don't do well, punish them. It makes it clear to everyone that bad quality will not be acceptable. And if you want work done properly, picking the people to do tasks is a lot more than simply whoever's available at the moment. It's about picking people who have the right skills, experience, and also not giving every single piece of work to the star of the office. Otherwise they get overloaded and they can't do their work properly. So quality involves a lot of aspects, and my advice, again with this chapter, seems to be pretty consistent, isn't it? Learn this. Quality control comes up quite a lot on the exam, so make sure you know your stuff. And then we need to look at each specific piece of work. So each job we do for a client, we want quality control on this as well. Now, I think I said before, it's a very practical exam and quality control is no different. So let's have a little example that you might see as a question. So maybe a question says something like this. No audit planning meeting took place before audit work began. Trainees worked at client's premises on the audit alone. A trainee audited complex financial instruments whilst the audit senior physically verified tangible assets to check existence. Now, rather like the advertising example from a few minutes ago, there's a good chance that most of you are looking at that and going, Paul, it's pretty obvious that this isn't good. I know. Most students spot the issues on P7. That's not the point. The point is, how would you explain why these are problems? And one way to explain them is to use the quality control criteria and try and tie it back into that. So, if we go back to the notes, it says, quality control, all works should be suitably directed, supervised and reviewed. Well, if there's no audit planning meeting, the plan is where you direct your staff as to where the audit is going to focus. So this would suggest there will be a lack of direction to the audit staff. And if you know your audit standards really deeply, which let's face it, you probably don't, but if you did, you could also say that this breaches ISA 300 and 315 in fact, because there must be a meeting of all key audit staff before the work begins. It's the rules. Now, the question might then ask you to go further and decide why all this is going wrong. Why has there been no planning meeting? Who do we blame for this? Well, probably it's the partner's fault, because they should know the audit rules and they should know that a meeting is required. There might be other reasons behind it, but simple fact is, blame the partner. Don't blame the staff. If no one calls you to a meeting, you can't go to it, can you? Second one, if trainees are working at the client's premises on the audit alone, that would suggest a lack of supervision. Whose fault is that? Well, you might argue it's the audit senior's fault for not going with them. But it might not be the senior's fault. The senior might have been allocated too many jobs to do by audit managers. So maybe the manager has overloaded the senior. Maybe it's the manager's fault. You could argue it's the partner's fault, because maybe this partner believes that juniors, trainees are perfectly capable of working on their own and has instructed the other people not to go. The answer is, I don't know. Of course, the worrying thing is, if this is what all the partners think, this will happen on every audit, not just this one. A trainee audited complex financial instruments while the audit senior physically verified tangible assets to check existence. Let's go back to the chapter. It says, suitable consultation with others where matters are unclear. Okay. Hot review, we've seen that before today and before on the course. Careful thought about which member of the team should perform and review each task. Well, if you've got complicated stuff, surely someone fairly senior should do it. Checking an asset exists is about as basic audit work as you can do. So going back to our little example here, whoever delegated this work is a bit of an idiot. Whose fault is this? Whoever allocated the work. Might be the manager, might be the senior, might be a senior being lazy, of course, and saying, "Oi, trainee, you go and do that and I'll do that." Could be all manner of things, I don't know. But this is a disaster waiting to happen. The trainee can't deal with financial instruments, and the senior's more expensive time is being wasted on relatively easy work. So as you can see, Chapter 3 is basically common sense, isn't it? I mean, tendering was easy. Just imagine you're applying for a job. Quality control looks pretty easy. And the advertising rules look pretty common sense as well. The fee stuff we'd already done, and the appointment issues you did on F8, and they're easy as well. So the message with Chapter 3 is make sure you know your stuff, because there's no excuse not to, because it's not difficult. But the key is to practice applying it, and you will get some practice on that very soon. But as far as tonight's class is concerned, we won't be doing any practice on it. You've been shown some examples. You'll get an opportunity very soon. Oh yes. What we're going to do to finish off tonight is we're going to go take a look at the beginnings of Chapter 4. Now, we're not going to go very far with it tonight, not very far at all, but I just want to remind you of some basics from the F8 course, one thing in particular to help set us up for next week's class. Let's face it, the first 3 chapters are not that killer, are they? They're not really going to hurt you. Chapter 1 is fairly easy, ethics is fairly easy, practice management seems just like common sense. And yet we all know that the pass rate for P7 isn't great. Well, Chapter 4 is where it starts to hurt. The knowledge in Chapter 4 is pretty much all knowledge you should already have. That's not the problem. The problem is we need to cover the knowledge quickly and then get straight into exam questions to show you how you use the knowledge and the understanding to get really good quality marks. It's all practical. With the added problem, or if you like, the added reward, that I promise you that the first 2 things in this chapter, not only will they come up on your exam, they will come up for big marks. Chapter 4 is the sort of core of the audit process. It's the planning, it's the substantive testing to get the evidence, and it's the finalisation process before the audit report is issued. And these 2, will definitely be on your exam and will definitely be worth a stack of marks. Realistically, you could be looking here at 35, 40 marks out of the 100 you need to get. And most of the marks will be compulsory questions. So you're doing this whether you like it or not. So as I said, the starting point here is to give a little reminder, a little introduction, just so that next week's class starts well. So what we're going to do, therefore, is remind you about the basics of one element of planning, and that's risk. By the way, you'll remember I talked about accounting standards, and they're all in the notes. Well, there you go. Loads of lovely accounting standards. But before we get to that, we need to consider risk, because question 1 on the exam is always an audit planning question. And audit planning will definitely involve looking at information, finding some risks, explaining some risks. All I need to do to finish off tonight's class is a brief reminder of the audit risk model. So you remember how we're doing this and what we're doing, so that next time I can focus very much on the practical, and that means next time going straight into a big question 1 monster case study and showing you it's really not that difficult if you've got the right skill set because you've practiced it. So, a little reminder to finish off tonight. It's in the class notes, but I'm going to do this on a separate page, just so I can lay it out and talk you through it as we go. So, audit risk. What is audit risk? Audit risk is the risk that the audit goes wrong. In other words, it is the risk the financial statements are materially misstated, or if you prefer, wrong, and audit tests fail to detect this. So, in other words, the accounts are wrong and the auditor didn't spot it. So, if we just put this out along the top here, there are 2 main reasons why accounts might be wrong. One reason is the nature of the client. So, very simply, if I'm auditing a chain of coffee shops, my life is relatively simple. They buy products, they sell products, there's no nasty accounting rules going on, it's all pretty basic. If I'm auditing a bank, it's complicated, because banks have got multiple currencies, they've got lots of financial instruments going on, it is going to be difficult. That type of risk is called inherent risk. The risk the accounts are wrong purely because of the nature of the client. And the second reason, contributory factor for accounts being wrong, is weak control systems. And that is known as control risk. So the first 2 components of the audit risk model, or one component, if you want to combine them and call them the risk of material misstatement, are both about the nature of the client, which means as an auditor, all I can do is measure them. I can't change them because I'm not the company. I can advise my client on how to improve their controls for next year, but for last year, which I'm auditing, I am stuck with their control system and however complicated their business model is. The third element, of course, is detection risk. So this is the risk that the auditor doesn't spot mistakes. And the auditor can control this. So the idea, of course, is we want audit risk overall to be relatively low because we don't want to screw up the audit. We can't change inherent and control risk. They are what they are, and they might be quite high. What we can do is if they are high, we can get detection risk to fall, and to lower detection risk. Well, if detection risk is the risk that our tests don't spot mistakes, do more tests. Sounds pretty obvious, really, doesn't it? So that is the audit risk model. Hopefully it looks relatively familiar from your F8 studies, which might have been some time ago. It's highly unlikely you'd have to explain that on this course, but on P7, if you understand this, it does help a little bit in answering the practical questions, which is where we need to go next with this. Well, the good news, my friends, exactly at 8:30, I've got the timing to work, that is it for this week's class. Homework. In the revision kit, question number 8 is good practice of the practice management stuff we were doing today. I think I've mentioned this other question before, but just for safety, also in the kit at the back is the December 2007 paper, question number 4. That's good practice of ethics, but as I said, I think I might have mentioned that one before. And apart from that, that is our class number 3 finished. So thank you all very, very much for being attentive, asking a few questions, especially Ramsha, who has been the star of the show today in terms of volume. Thank you all. Again, if you have any issues between now and the next class, feel free to email me. Keep an eye out for a revised study planner. None of the dates are changing on the course, don't worry. But just in terms of telling you the order as we go through the course. And I will see you in 7 days' time when we shall do all this fun again. Have a very pleasant week. Bye-bye. Glad you enjoyed it, guys. I had a good session too.